should clarify that, when I say there's a shortage of power for mining, it's a shortage of ready-to-use power. The missing thing is the racks and the transformers and the cooling and the switchgear, right? Because there's lots of underused power, like not used to its full capacity, because most capacity planning is based on a peak use, and so it typically goes under half used in most places, right? So there's typically an enormous amount of power that is not being used continuously. And so, yeah, I think the gap for a lot of places is that, the gap for currently is not, there's plenty of power around and Bitcoin can mine anywhere. It's that it takes a lot of capital to build the infrastructure. So to buy the transformers, to do the electrical installations, the filtration, cooling, etc. I think that the Bitcoin mining sector is undercapitalized, and the reason for that is, if you look at any other industry like cars, computers, mobile phones, etc., there's a whole area of finance behind that, which is providing factoring or working capital loans to fund the development, the manufacturing, to build inventory, to sell, and that's the whole cycle there. And that cycle is largely missing in the Bitcoin sector because it's so new, and conventional finance historically has, not understood the asset class or viewed it as high risk and so extremely high interest rates. And so you see that throughout the system, right? Both on the trading side, on the margin lending, there's a huge gap between Bitcoin related margin lending and stock and share margin lending on brokerages, right? The interest rates are double digit versus single digit low, right? And it sort of pervades the other aspects. So apart from the mining infrastructure, also the manufacture of miners, no miners are selling you miners from inventory in a normal market. And so they are asking the customer to make pre-orders and payments in stages, because they're basically using customer financing, because they can't get factoring or corporate debt or any of the usual kinds of financing. And also the foundries, the people they would pay to do mass production, the actual assembly companies are less likely to give credit, like manufacturer credit, and the foundries are less likely to give credit because they view it as a risk sector and they don't understand it. So I think those things are gradually improving, and some sort of forward-thinking people from the conventional finance world are, starting, I would say last year, and it's improved from there, to get more active in the space and understand and provide financing. So that might improve some of the liquidity problems. And I think that also underlies the over-leveraged nature. Like, people needed to expand and they needed the capital to do it. And so they took it from the only place they could, which was, the Bitcoin and the miners, which was a high-risk thing to do. Now, normally in any other sector, they would have used conventional corporate financing. So that's part of that structural, I think the Bitcoin sector's structural problem for the short term. But what's happened in the last year is that last year there was, the Bitcoin price was high, and a lot of people made orders for miners, and you have to prepay and pay long in advance. And so, with the price correction, they're still receiving the miners, and there's a shortage of power. So even though mining profitability is down, hosting demand is enormous, and there's a big backlog and equipment depreciating in data centers. Just in storage facilities, basically, new on pallet, as they say. And so what we have been doing for the last year is doing the preparatory stages to expand to new mining locations. So new sites adjacent to or very close to large low-cost sources of power. So we have about 500 megawatts across multiple sites, at a stage where we can put money on the ground and build out the infrastructure. And the infrastructure is containerized, and we have a kind of pipeline process to do that. And it has actually a quite good margin, but it's capital intensive, hence raising money. So we have people queuing up to buy power, and that's across the industry, to send miners and power them up, but there's a shortage of it. So we're trying to, get market share and satisfy that demand with our modular deployment strategy.